when you have institutional lenders that can now start to put larger sums of money to work, that can use the data, that can have their own algorithms, do we see a model where the platform could still say, here is what we think Alex's risk rating is. Here is all the data that Alex provided about the loan that he wants and his credit profile, so on and so forth. And is there a way where we can have these lenders compete over my loan? What was very interesting in this article was the description of now, this is now a number of years ago, Zopa going beyond just what you would consider peer-to-peer. And peer-to-peer would imply individuals are lending to other individuals. But this was, I think, probably the first case. I think they have some other partners now that aren't necessarily all banks. I think there's some funds that are doing this, but where they're now getting institutional money to come and provide capital to the Zopa borrowers. I think this model is really interesting. And I would imagine is working pretty well for them. Is there any other context that you can share on that?
No, I mean the way I look at it is that Zopa has built, might be a very successful peer-to-peer lending platform, and there are other players out there, Metro Bank or other funds who have access liquidity. And peer-to-peer, an individual investor who likes the platform as an investment, that's an interesting way to deploy excess liquidity. So and for Zopa, they have a mix between funding from individuals and funding from institutions.
Lending Club, which started as peer-to-peer. A lot of people have criticized Lending Club because now the peer-to-peer lending side of the business has actually declined a lot, and it's more so gobbled up by just a handful of large banks and institutions. I see that model with Lending Club as being different than Zopa. I see Zopa working with institutions, but not the kind of incumbent banking institutions that Lending Club is working with. Is that accurate, Nick? Would you say?
Lending Club works with a pretty broad swath, including a lot of the big institutions, Goldman, hedge funds, big banks.
And I think what's interesting here is the difference between a personal lender, where Zopa says, hey, let's say Alex is applying for a loan. Here is the credit risk. I think they have ABC. They have different grades they're going to provide to my application. And then they are associating that with a certain level of interest rate that then they are now letting individuals lend to really a portfolio. So, if I'm a lender, I put in $10,000, they might split that $10,000 across, let's say, 10 loans. And me as the lender, I can pick what risk profile I want for that basket and so on and so forth. The larger institutional lenders here will obviously need to put much more capital to use, so they will provide the whole loan, say to me. But what is interesting, I think, and this isn't, say, Zopa specific, is when you have institutional lenders that can now start to put larger sums of money to work, that can use the data, that can have their own algorithms. Do we see a model where those institutional lenders, the platform could still say, here is what we think Alex's risk rating is. Here is all the data that Alex provided about the loan that he wants and his credit profile, so on and so forth. And is there a way where we can have these lenders compete over my loan? And let's say one lender is now, they are creating their own interest rate to suggest what they would lend to me at. Maybe one says, well, I'll give Alex 6%. And one says, I'll give Alex 5%. Is there a way that you can now centralize these transactions and kind of put a forcing function on the lender base to do that competition? Is that a direction you see the industry going? Is it already there?
No, I mean, of course, that can happen, and of course, you can look at it both sides. Now, I'm not sure if Alex is a good example. I guess it depends on the size of your needs, I guess. But the point I'm making, it always depends. If there is excess liquidity, which as a result of too much quantitative easing, yes, then they're going to all compete about Alex's loan. If there's not enough liquidity around, you will have to shop around and see who will give you the best rate. So it's, it can turn around, but you're absolutely right that with platforms, a scenario where lenders compete about being able to give you the money is realistic and feasible, and it wasn't 10 years ago.
Hi, this is Alex from Winner Take All. Thanks for joining us. Hope you enjoyed the content. Feel free to leave a comment, ask us questions, and definitely make sure to join us on our next live stream.